Welcome to Griffonomics.
It is really great to be here.
So today, we are taking a deep dive into something that, frankly, sounds like a riddle.
A very profitable riddle.
Exactly. We are looking at a company that, on paper, shouldn't exist in the form it does today. I mean, if you looked at this company 10 years ago, you'd see a dusty, boring, completely passive collection of assets just sitting there.
A literal relic from another century. We are talking about a corporate structure that literally predates the Wright brothers inventing the airplane.
Right, 1888.
Yeah.
But if you look at this company today, and specifically if you look at the fiscal year 2025 earnings report that just dropped yesterday on February 18th, 2026, you do not see a relic.
No, you see an absolute monster of a cash machine.
A machine operating with margins that make the biggest Silicon Valley software monopolies look like they don't know how to run a business.
Which is wild when you consider their core assets are rocks and dirt in West Texas.
So the mission of our deep dive today is to tear apart those FY 2025 earnings and analyze a massive pivot. We are talking about Texas Pacific Land Corporation, ticker symbol TPL.
And we are going to unpack how a company famous for oil and gas royalties is suddenly positioning itself as the critical picks and shovels provider for the AI economy.
Right, partnering with former Google executives to build gigawatt-scale data centers. It's a massive transition from old energy to new compute.
And to really wrap your head around it, you have to start with what analyst Leo Nillison recently called the duck test.
The duck test.
Yeah, you know the old saying, if it looks like a duck and swings like a duck and quacks like a duck.
It's usually a duck.
Right, but TPL completely breaks the duck test.
How so?
Well, it looks like an oil company. It operates in the Permian Basin, which is the absolute heart of American fossil fuels. Its neighbors out there are Chevron and Exxon, so it looks like a duck.
Okay.
But when you actually open the hood and look at the financials, specifically when you look at the margins, it does not quack like an oil company at all.
It quacks like a tech monopoly.
Exactly. We are seeing net income margins hovering around 64%.
That is absurd for a physical business.
It is. And their adjusted EBITDA margins are hitting 84%.
84%.
Yes. I mean, those are Visa numbers. Those are MasterCard numbers. A traditional oil company, even a fantastic one, is usually doing backflips if they hit 15 or 20% margins.
Because they have to spend so much capital digging holes in the ground.
Exactly. So TPL posting an 84% margin tells you something is fundamentally different about their model.
So that is the mystery we are solving today. How does a company that owns dirt operate with the financial physics of a credit card network? And more importantly, is this massive pivot to AI real?
Or is it just a buzzword they slapped on a press release to pump the stock?
Right. So we are going to look closely at their deal with Bolt Data and Energy. We'll look at their 10 gigawatt ambition, and we're going to examine something that sounds like it belongs in a sci-fi novel.
Fractional freeze desalination.
It really does sound made up.
It sounds totally made up, but it might actually be the deepest moat they have.
Okay, but before we get to the futuristic water tech, we need to build a foundation. Section 1 of our deep dive. The business model.
We have to eat our vegetables first.
We do. Because I think there is a huge misconception out there. When you say Texas Pacific Land to people, they immediately picture guys in hard hats turning wrenches on an oil rig.
Which is the single biggest error you can make when analyzing this company. TPL is not an oil driller.
They don't dig the holes.
They never dig the holes. They don't own the drilling rigs. They don't employ the roughnecks. They don't buy the steel pipe.
So they spend essentially zero on capital expenditures for drilling.
Zero capex. They are fundamentally a landlord. That is the model.
A landlord with a lot of
A
land.
massive amount. They own roughly 882,000 surface acres and about 224,000 net royalty acres in the Permian Basin.
And just to remind you listening, this land goes all the way back to that 1888 railroad bankruptcy.
Right. The Texas and Pacific Railway went bust. The bondholders got paid in useless desert land. So their cost basis on this dirt is practically nothing.
Which perfectly explains those 84% margins.
It is the secret sauce. So let's look at their two main business segments. Segment 1 is land and resource management.
This is where the royalties come in.
Yes. So let's say Chevron wants to drill on a patch of TPL land. Chevron pays for the geologists, the rigs, the labor. They take 100% of the financial risk.
If they drill a dry hole, Chevron eats the loss.
TPL loses nothing. But if Chevron strikes oil, they are legally obligated to give TPL a fixed cut of the revenue right off the top.
A perpetual royalty.
Perpetual and zero cost. And within that same segment, you have something called SLIM.
Right. Surface leases, easements, and materials. the toll booth.
Exactly. Even if a company isn't drilling on TPL land, they probably need to cross it. The Permian is crowded.
So if you want to build a pipeline to move your oil from point A to point B,
You pay TPL a toll to cross their BERT. If you want to build a service road, you pay rent. Power lines, you pay rent.
and these aren't just flat legacy contracts either.
No, and this is a crucial detail for the current macro environment. These SLEM contracts often have built-in CPI escalators.
So they are automatically protected against inflation.
Inflation goes up, the rent goes up. It is an incredibly resilient cash flow stream.
Okay, so that is the land side. But looking at the FY25 numbers,
Yeah.
the second segment seems just as critical. Water services.
TPWR is the ticker for that subsidiary.
Yeah.
And it is arguably becoming the growth engine of the legacy business.
Which is funny because you look at West Texas and water is the last thing you think of.
Well, you have to realize the Permian Basin is really a water basin disguised as an oil basin.
Explain that.
For every single barrel of oil a driller pulls out of the ground, they are also pulling up anywhere from 5 to 10 barrels of produced water.
And produced water is not something you want to drink.
Oh, absolutely not. It is highly toxic, briny, often radioactive industrial waste. It is full of heavy metals.
So the drillers have this massive nightmare of a waste management problem.
Right. And on the flip side, they also have a massive supply problem. Because to frack a new well in the first place, you need to blast millions of gallons of water down into the rock.
And TPL sits right in the middle.
They catch them coming and going, TPL sources, and sells the brackish water to the drillers so they can frack. That is revenue stream one.
Sourcing.
Yeah. Then when the toxic produced water comes back up, the drillers have to pay TPL a volumetric royalty to inject that waste safely back into disposal wells on TPL land.
So they monetize the water going in and they monetize the waste coming out.
It is a closed-loop monopoly on the fluid dynamics of the basin.
That is just a brilliant business model. So with that foundation, let's look at the actual scorecard, the FY 2025 earnings released yesterday.
The numbers are frankly staggering, especially when you consider the macro context of 2025.
Right, because oil prices were not great.
They dropped significantly. Realized oil prices went from about $75 a barrel down to roughly $64.
That is a 15% haircut on the price of their main commodity.
So logic says their revenue should take a massive hit. But instead, TPL reported record revenues of $798.2 million.
Record revenue in a down cycle.
How? Volume completely beat price. They offset the cheap oil with massive operational volume growth.
Because the drillers were working harder to make up for the low prices.
Exactly. Oil royalty production, the actual organic volume of oil coming out, was up 23% year over year.
Wow.
And water sales volume was up 36%.
So the machine just ran hotter.
Yeah.
And because they don't have operational costs, that volume drops straight to the bottom line.
Which brings us to the Fortress balance sheet.
Let's hear the cash numbers. Because revenue is one thing, but free cash flow is what matters.
TPL generated $498.3 million in free cash flow last year.
$500 million.
And that represents a 62% free cash flow margin. Out of every dollar of revenue, 62 cents is pure unencumbered cash. That puts them in the elite tier of the entire S&P 500.
And the debt.
Zero.
Not a low debt-to-equity ratio, just zero.
Absolute zero debt. They have about $145 million in cash sitting on the balance sheet. And they just secured a brand new $500 million credit facility.
Which is totally undrawn.
It is pure dry powder.
Okay, so to wrap up section one, we have this legacy business that is completely countercyclical. It grows when oil falls, it has zero debt, and throws off $500 million in cash.
It is the perfect economic engine.
But if that was the whole story, we wouldn't be doing this deep dive. You'd just buy the stock, collect the dividend, and go to sleep.
Right.
We are here because of section two, the Great Migration and the strategic inflection point.
This is where the story shifts from old energy to the AI revolution.
Right. So TPL is making this massive pivot to data centers. And playing the skeptic here, I have to ask why. Why does a tech company building an AI data center want to be in the dusty Permian Basin? Why not stay in Virginia or New York where the fiber optic networks are?
Because the hyperscalers, the Amazons, the Googles, the Microsofts are running into a wall of physics and bureaucracy. The grid is simply full.
Bottlenecks.
Massive bottlenecks. Look at what we call the Virginia problem. Northern Virginia is data center alley. It handles a massive chunk of global internet traffic.
Right, Ashburn and all those places.
Exactly. But if you go there today to build a new hyperscale AI facility, the local utility Dominion Energy is going to tell you the wait time to get the power you need is up to 6 years.
6 years. In the AI arms race, 6 years means you lose.
It's an eternity. You can't wait until 2032 to train your next language model. So Virginia is out.
What about New York?
New York has a different issue. The New York problem is regulatory. You have political moratoriums and bills like Senate Bill S 9144.
Right, and to be clear, we aren't taking any political sides here on the environmental policies. We're just impartially analyzing the regulatory reality for these companies.
Absolutely. The reality is that Bill acts as a kill switch for new high-load data centers and crypto mining because of concerns about stressing the power grid.
So if you are a hyperscaler, you can't get power in Virginia and you aren't allowed to plug in New York.
So you look at a map of the U.S. and you realize you need a very specific set of ingredients.
What are they looking for?
3 things. You need massive tracts of unpopulated land so you don't get noise complaints. You need a deregulated power market so you can move fast. And you need direct, immediate access to energy molecules.
Which sounds exactly like TPL's acreage in West Texas.
It is a perfect match. 880,000 acres in ERCOT's deregulated jurisdiction, sitting directly on top of the largest natural gas reserves in the country.
But wait a minute. ERCOT is the Texas grid. And historically, ERCOT has had some highly publicized reliability issues during extreme weather. Why would a billion-dollar AI project rely on that grid?
That is the genius of this pivot. They aren't going to rely on the grid. They are going behind the meter.
Behind the meter. Okay, we need to unpack that. What does a behind-the-meter setup physically look like?
In a normal setup, you have a power plant far away. It generates electricity, sends it over miles of high-voltage transmission lines to a substation and eventually to your building.
You are totally dependent on the utility company's infrastructure.
Right. In a behind-the-meter setup, you cut the utility out entirely. You build your data center right on the land. You drill a natural gas well 500 yards away.
Okay.
You drop a gas turbine right next to the well. You burn the gas to make electricity, and you run a private wire directly into your server farm.
So you become your own island of power.
Exactly.
Yeah.
You bypass the grid, you bypass the 6-year wait times, and you bypass the regulatory red tape.
And TPL owns the land you build on and the rights to the gas you burn.
They own the entire physical layer of the operation.
Which brings us to the Bolt Data and Energy deal from December 2025.
Yeah.
This was the moment it became real.
Yes. TPL didn't just issue a press release about AI, they wrote a check. They invested $50 million into Bolt.
Which, for a company generating $500 million in cash, is basically pocket change.
It's a highly asymmetric bet. But the partner is what matters here. Bolt is co-founded and chaired by Eric Schmidt,
The former CEO of Google.
Right.
Yeah.
So you have someone who intimately understands the exact specifications and desperation of the hyperscalers.
He knows what they need.
And TPL structured this deal brilliantly. They got equity, they got warrants, but crucially, they secured a right of first refusal, an ROFR.
For the water.
For the water. TPL has the exclusive right to supply water to all Bolt-affiliated projects. Bolt cannot shop around for a cheaper water utility.
And we aren't talking about small server closets here. What did the CEO, Ty Glover, say about the scale?
On the earnings call, he was very explicit. He said they are not interested in a hodgepodge of small 100 or 200 megawatt centers.
So what is the goal?
The goal, he stated, is multiple multi-gig energy campuses.
Multi-gig, I mean, just for context for you listening, a single gigawatt is roughly the power required to run a city the size of San Francisco.
And they want to build multiple campuses at that scale.
Which sounds incredibly ambitious.
Yeah.
Almost too ambitious. So let's bring this down to earth and get into Section 3, the triple stack economics.
Let's do the math.
Because it's easy to wave your hands and say AI is a multi-billion-dollar opportunity.
Right.
But how exactly does TPL extract cash from one of these data centers?
They monetize it in 3 distinct layers. Unlike a normal landlord who just collects rent, TPL gets paid 3 times.
Okay, walk us through a theoretical 1 gigawatt campus, layer 1.
Stack layer 1 is the ground lease. You need about 400 to 500 acres for a facility this massive. Now, normally, desert land is dirt cheap. But this is premium, shovel-ready industrial land with guaranteed energy access.
So they can charge a premium.
Right. Analysts project TTL can charge between $1.5 million and $2.0 million per year in rent for that parcel.
Okay, but I'm looking at a company that just made $800 million. $2 million is a rounding error. If that's the whole thesis, I'm not impressed.
And you shouldn't be. The ground lease is just the cover charge to get into the club. The real money is stack layer 2. Water sales.
Hidden alpha?
Data centers generate an unfathomable amount of heat. Cooling those AI chips is thirsty work. A single 1 gigawatt facility requires approximately 350,000 barrels of water every single day.
350,000 barrels a day.
Every day. That covers the cooling towers for the servers and the water needed for the power generation turbines.
And TPL has the ROFR to supply that water. What is that contract worth?
Estimates put that recurring water revenue at $12 million to $25 million per year. High margin.
Okay, so now we are talking real money. Up to $25 million just for the water. What is layer 3?
Stack layer 3 is the power and gas royalties. This is the arbitrage play.
How does that work?
The data center has to burn natural gas to generate electricity. TPL owns the royalty interest on that gas.
Even if it's consumed right there on the property.
Especially then. Now you have to understand the dynamic of Permian natural gas.
Right.
Right now at the Waha Hub, the local trading center, the price of natural gas is terrible. Sometimes it is literally negative.
Wait, negative pricing. Explain that for someone who doesn't trade commodities. How can gas be less than zero?
Okay, imagine you are drilling for oil. Oil is highly profitable, but gas comes up out of the well at the same time. You don't want the gas.
But you can't just vent it into the atmosphere.
No, the EPA will shut you down. You have to put it in a pipeline. But there aren't enough pipelines. They're totally full.
So you have this byproduct you can't get rid of.
So you literally have to pay someone else to take your gas away just so you can keep pumping the lucrative oil. That is negative pricing.
So to a driller, the gas is toxic waste, financially speaking.
Right. But to an AI data center developer, that negative cost gas is the most valuable fuel on Earth. They build the turbines right on site and consume that trapped gas.
And TPL gets a royalty on the value created.
Exactly. Even if the gas is nominally free at the hub, the economic value realized inside the data center complex is massive. Analysts estimate TPL's royalty cut from the power generation of a 1 gigawatt site could be $20 million to $30 million per year.
All right, let's add up the triple stack. $2 million for the land, let's say $20 million for the water, and maybe $25 million for the gas royalties.
So you are looking at roughly $35 million to $50 million in annual recurring high-margin revenue per gigawatt.
And their ultimate stated ambition with the Bolt partnership is 10 gigawatts.
Which brings us to the total addressable market, 10 gigawatts times $50 million.
That is $500 million in incremental annual operating income.
Just from this one initiative.
And let's put that in context. Their total adjusted EBITDA for the entire legacy business in 2024 was about $611 million.
So if they execute this 10-gigawatt vision, they effectively double the earnings power of a 130-year-old company.
Without taking on debt or drilling a single hole.
It is an infrastructure masterclass.
Okay, but I have to stop you here. Section 4. Because there is a massive glaring hole in this thesis.
The water problem.
Yes, you just said a single gigawatt needs 350,000 barrels of water a day.
Every day.
We are talking about the Chihuahuan Desert.
Yes.
If TPL starts draining local freshwater aquifers to cool down servers so a tech bro can generate an AI image, the local ranchers are going to riot. The state regulators will shut them down immediately. You cannot use fresh water for this.
You are 100% right. Using fresh water is a political and environmental non-starter. It would kill the project on day one.
So where do they get 350,000 barrels a day?
They use the produced water, the toxic waste from the oil wells.
But you can't run toxic radioactive brine through highly sensitive data center cooling towers. It would corrode the entire system in a week.
Which is why it has to be desalinated and cleaned first.
Okay, but traditional desalination like reverse osmosis is notoriously expensive. Yeah. And doesn't the oil in the water just ruin the filters?
Exactly. Reverse osmosis is great for seawater, but if you push oily Permian sludge through an RO membrane, it clogs instantly. It is useless here.
So what is the solution?
This is the technological moat. TPL is investing heavily in a process called fractional freeze desalination.
Freeze desalination. Again, this sounds insane. It is 110 degrees in West Texas in the summer, and you want to freeze water to clean it.
It sounds totally backwards, but the thermodynamics actually work.
Explain the physics of it.
When you take salt water and freeze it, the ice crystals that form are pure H2O. The physical structure of the freezing ice literally pushes the salts, the heavy metals, and the impurities out of the crystal lattice.
So it's like how sea ice in the Arctic is actually fresh water, even though it forms from the ocean.
Perfect analogy, yes. So if you freeze the toxic produced water, harvest the pure ice crystals, and then melt them, you get perfectly clean fresh water.
Okay, I buy the physics.
Yeah.
But The energy cost to freeze hundreds of thousands of barrels of water in the desert has to be astronomical. It would ruin the economics.
It would if you had to buy power off the grid to run giant freezers. But this is the aha moment, the synergy.
Wait, what's the synergy?
What is the single biggest waste product of a gigawatt AI data center?
Heat, just massive amounts of thermal exhaust.
Exactly. So TPL co-locates the desalination plant right next to the data center. They capture all that free waste heat from the server exhaust and the gas turbines.
And they use heat to freeze water.
Yes, through a process called absorption cooling.
Like an old propane refrigerator in an RV.
Exactly like that. You use a heat source to drive a chemical cooling cycle. So they take the dirty, toxic water, they use the free waste heat from the AI to power the chillers, they freeze the dirt out of the water.
And then they melt the clean ice.
And they have millions of gallons of chilled, pristine water, which they then pipe right back into the data center to cool the servers.
It's a completely closed thermodynamic loop.
It is brilliant engineering. They take a waste liability from the oil drillers and waste heat from the tech companies and synthesize them into a critical resource.
Did management talk about this on the earnings call?
They did. They've already allocated $20 million to build a pilot facility for this in Orla, Texas. CEO Ty Glover specifically said this tech could be, quote, pretty material to the water business over the long term.
And that solves the environmental bottleneck. Nobody else has the toxic water, the land, the gas, and the tech all in one package.
It's an unbreachable moat.
Okay, I am thoroughly impressed by the model. But we need to look at reality. Section 5. The valuation conundrum.
Because the market already knows this is a good company.
Right. TPL trades at a multiple of around 40 times earnings.
Which is very high.
It's incredibly high. NVIDIA trades at a high multiple, but they are growing revenues at 100 or 200%. TPL is technically an oil royalty stock. Look at Chevron. They trade at, what, 11 times earnings?
Right around there, yes.
Exxon is maybe 12 or 13 times.
Yeah.
So if I'm a skeptical value investor, why on earth would I pay 40 times earnings for an oil stock?
If you view TPL strictly as a proxy for crude oil prices, you absolutely shouldn't. It would be massively overvalued.
So what is the bull case? Why are firms like KeyBank and Horizon Kinetics so bullish at this price?
It comes down to a sum of the parts valuation and something called the free option.
Walk me through it.
The bulls argue that the legacy business, the oil royalties, the slum rent, the water disposal, is so robust, so high margin, and growing so consistently that it justifies a premium baseline multiple.
Okay, so maybe that justifies 25 or 30 times earnings just for the legacy stability.
Right, which means the premium you're paying above that is actually incredibly cheap for what you're getting.
Because you are getting the AI business.
Yeah, exactly. Investors are essentially paying for a world-class oil royalty business, and they're getting a multi-billion-dollar AI infrastructure startup attached for free.
The optionality is mispriced.
Highly mispriced, according to the bulls.
And there is another asset that we touched on that isn't really priced into current models at all, right?
The unpriced gas asset. This is huge.
We talked about Waha natural gas trading at negative prices.
Right, because local prices are zero or negative. Most financial analysts have modeled TPL's future gas royalties at roughly zero. It's just a blank cell in their spreadsheets.
But that bottleneck isn't permanent.
Not at all. There are massive new takeaway pipelines coming online in 2026. These will connect the Permian Basin directly to the LNG export terminals on the Gulf Coast.
So that stranded gas suddenly has a path to global markets.
Which means the local Waha price will rapidly converge with the national Henry Hub price.
So gas goes from negative to $3 or $4.
And remember, TPL gets a royalty on that gas. And the wells are already drilled, the gas is already flowing, TPL just hasn't been getting paid for it.
So the moment those pipelines open, TPL unlocks a massive new revenue stream that requires literally zero effort on their part.
It is hidden revenue that is about to drop straight to the bottom line.
Okay, I see the bull case very clearly now. But it is our job to define the risk. What breaks this thesis?
There are three main risks you have to watch.
Number one.
Execution risk. We just spent 20 minutes talking about 10 gigawatts of power and massive AI campuses, but how many have they actually built today?
Zero.
Zero. They have the land and they have the Bolt partnership, but as of this deep dive, they have not announced a signed binding lease with an anchor tenant.
Right. Until Microsoft or Amazon signs a 20-year contract, this is all just a great PowerPoint presentation.
Exactly. Construction could be delayed, technology could shift.
Yeah.
The hyperscalers might invent more efficient chips that don't need as much power. The execution is not guaranteed.
Fair enough. What is risk number 2?
Commodity price sensitivity. At the end of the day, today they are still highly dependent on oil activity.
So if oil crashes,
If WTI crude falls below, say, $60 a barrel, the drillers are going to lay down their rigs. They stop drilling new wells.
and if there are no new wells, TPL gets no new royalty growth.
Their revenue would flatten or decline. The AI project might save them in 2030, but the stock would suffer heavily in the short term.
Okay, and the third risk, you mentioned regulatory.
Regulatory risk specifically regarding earthquakes.
Earthquakes in Texas.
Induced seismicity. When drillers inject millions of barrels of that toxic produced water deep into disposal wells, it alters the subterranean pressure. It lubricates fault lines.
It causes earthquakes.
Yes, and the Texas Railroad Commission, which regulates this, has started cracking down. They are designating seismic response areas.
And if TPL's disposal wells end up inside one of those areas,
The regulators can force them to reduce disposal volumes or shut down the wells entirely.
which would instantly kneecap the TPWR water segment.
It is a hard physical and regulatory constraint that investors have to monitor.
So it is absolutely not a risk-free play. You are betting on flawless execution, stable oil markets, and favorable geology.
Exactly.
Okay, so we have covered the 1888 origins, we covered the 84% margins, the Great Migration, the triple stack, and the freeze desalination. Time for the final verdict.
The analyst community is overwhelmingly positive. KeyBank recently reiterated an overweight rating with a $1,050 price target. Seeking Alpha Quant ratings have it as a strong buy.
How would you synthesize the whole thesis?
TPL is fundamentally miscategorized. It is not an oil driller. It is a vertically integrated triple-stack infrastructure monopoly. It owns the dirt, the water, and the energy molecules that the AI revolution desperately needs.
The ultimate picks and shovels play.
In the 1849 gold rush, the guys who made the real money were selling the shovels. In the AI rush, the real money is in selling electricity and cooling water,
And TPL sells both.
while collecting rent on the land you stand on to buy them.
I want to leave you listening with one final provocative thought that builds on everything we've discussed today.
Go Foods.
We talked extensively about this fractional freeze desalination technology being used to cool AI servers, right?
Right, to solve the local bottleneck.
But let's zoom out for a second. We are moving into a century where global freshwater scarcity is arguably going to be a bigger crisis than energy.
Undoubtedly.
If TPL actually perfects this technology at commercial scale, if they prove they can take the most toxic industrial brine on Earth and turn it into pure fresh water cheaply using waste heat.
Then the AI data centers are just the beta test.
Exactly. They suddenly own the intellectual property and operational blueprint for a technology that every municipality, every factory, and every arid country on Earth is going to need.
That technology alone could eventually spin off and be worth more than the oil and the real estate combined.
You might be buying into a 130-year-old land trust that inadvertently morphs into the most important water technology company of the 21st century.
It's the ultimate shapeshifter. Optionality layered on top of optionality.
It really is. Well, that is a tremendous amount of data to process, but that is exactly why we do these deep dives.
To find the actual signal through all the market noise.
Absolutely. Thank you for joining us for this deep dive into Texas Pacific Land Corporation. We hope you found some real value in this analysis.
It's been a great conversation.
Risk defined. Portfolio protected. We will see you next time.